We cover in this video how an investment banker's duties and responsibilities changes when a banker gets promoted up the hierarchy. The roles and duties in investment banks can vary from firm to firm, but the general hierarchy follows. Analyst. The analyst is the most junior level in the investment banking industry. Most often, an investment bank would hire an analyst for 2 to 3 years. Often an analyst is allowed to stay for a third year before exploring other options. If an analyst does stay for a third year, it is recommended to do so in a different group to expand network and gain more skills. After 2 or 3 years, an analyst may be able to get promoted to the associate level, or be required to go to business school and get an MBA before getting a promotion. Sometimes, however, an analyst moves on to venture capital or private equity or leaves the industry altogether. The key roles of an analyst entail financial modeling, updating presentations, drafting documents, facilitating research, performing due diligence, and setting up meetings. Associate. An associate is one position above the analyst. Associates are responsible for the technical and documents in a transaction. They are responsible for the quality of output of presentations, the data and flow of key documents, and the execution of deal process. Associates manage the analysts and aid in quality control of their work. An associate role will typically last 3 to 4 years before getting promoted to vice president. There is a major distinction here between the role of an associate and the role of a vice president, which often becomes a big hurdle for budding vice presidents. Analysts and associates have largely technical roles, responsible for the underlying data, materials, and process of transactions. Once transitioned to VP, one is more responsible for structuring and selling the deal. A more client-focused role. Often very technical candidates are great analysts and associates, but are not personable or articulate enough to be good vice presidents. This causes a roadblock for many junior bankers. Vice president. Typically, the vice president, although still responsible for technicals and execution, starts to gain exposure to the management process, including more direct interaction with the client. The duration of service varies vastly from firm to firm. We've seen vice presidents stay in their role for many years or get promoted after 3 to 5 years. It completely depends on the firm, their staffing needs, and the state of the markets. Director. The director is also another vague role. Some firms refer to this role as executive director or president, and the specifics vary. Directors typically shadow managing directors and are being groomed to be the next key contact for a client. The move from director to managing director is typically not as structured a time as from analyst to associate. It largely depends on the state of the particular investment banking group. Managing director. The managing director is the key client relationship holder. The managing director is responsible for advising the client on particular M&A or underwriting products. The success of the managing director's role is often determined by how many products can be sold to the clients, which are covered by the managing director.